Come on. Good morning. What's going on? There we go. What's going on, everybody? We are going to make some trades here. I'm going to actually do some trades, make some adjustments to some positions, and talk through some stuff. So I hope that's helpful for you. It's user time. Looking forward to the new content. Thank you. I appreciate that. So to talk a little bit about that, in my last video, I talked about changing the content on the channel. So for the past 5 years, since 2016, the channel has been strictly focused on options, and the channel name is Project Option, which makes sense. But after 5 years of doing this, I would like to broaden the scope of the channel. And a lot of people interpreted that video as a hard shift away from options, but that's not what's happening. It's basically going to be at least 50% of the content will still be options focused, and I'll still do live streams like this, which will be live market stuff, options focused. So there's still going to be a lot of options content, but I personally believe that it is really important to broaden your horizons when it comes to investing and personal finance. And what that means for the channel is that the content will expand, but for the most part, it will be about investing, but it may not be strictly about options. So we'll talk about ETFs, investing in stocks, various investment vehicles, and just investment concepts overall, as opposed to strictly focusing on options. So will it include your thoughts on crypto? Yes. So I would like to rephrase crypto to Bitcoin. So I'm not going to be hyping tons of different altcoins or talking about tons of different cryptocurrencies. It will have a strong focus on Bitcoin because that's where my heart is. And personally, for me, I think it is the absolute number one opportunity for a long-term investment position is Bitcoin for me, just based on everything that's available right now. And I'll make a video talking more about that, but yes, there will be some crypto stuff, but as I said, crypto mainly being Bitcoin. Thank you, Fuentes. I appreciate that. So yes, going forward, there will be more content on the channel than just option stuff, but the core of this channel started as an options trading channel, and so there will be lots of options content on this channel, and my target is at least 50% of the videos going forward will be options focused, but it could be more than 50%. It just depends on what's going on and what I want to talk about or what I want to make a video on. So, all right. So Tara says, because of you, I'm profiting from trading options. That's phenomenal. I'm glad I can help. And keep up the good work. Tara says, everyone hit the like button. Yes, if you could hit that like button down below, that would be greatly appreciated. And then we're going to get started here very shortly. I want to talk about NVIDIA because NVIDIA has been going pretty crazy. They just had a blowout quarter, and so as we can see, NVIDIA just popped up to new all-time highs. And I do have some call options in NVIDIA that are long-term. So what I'm going to do in NVIDIA is I'm actually going to make that adjustment for a portion of the position that I talked about in my favorite options strategy video. And in that video, I talked about buying call options that were long-term. And once those call options become profitable, one way that you can adjust them and reduce your risk significantly, if not reduce all of your risk, or even lock in a guaranteed profit by shorting a higher strike call option for a higher premium than you initially paid for the lower strike call option. So I'll explain more of that in a little bit. Thundercat, thank you. So yeah, that's my Thundercat says, I saw your video regarding new content. Just do it as long as you're as educational and detailed as your other videos. I will watch it too. Your delivery info so clear. You deliver info so clearly. Thank you. I appreciate that. And that was my strong hope, is that people would be receptive to more content as long as I stayed true to the content. And yeah, I'm not going to put out a video unless I think it is extremely valuable and helpful. So I will stay true to my delivery of content as best as I can. Tara says, just profited on call contracts 400%. NVD. Let's go. Drew Murtis. Oh my gosh. Blast from the past. How's it going, man? We got to get together. Drew is the brother of one of my childhood best friends. And I miss them very much. We all got to get together and regroup, catch up. Thank you, Santiago. Mangled Mango says, it seems that every short-term option I've bought has gone against me every time. It's crazy. I've lost so much money. So the problem, and this is an important thing to discuss, is that the problem with short-term options trading is that you make or lose money very quickly, and there's really no middle ground, because short-term options are extremely sensitive to changes in the stock price. So what I can show you is NVIDIA is up $15 today, and we can see that it's had this massive run. If I look at, let's go ahead and look at the 575 put option, and let's look at the short-term put option in NVIDIA just to see. And I'm going to plot this on a chart. So the way I can do this in tastyworks is right now I've opened up NVIDIA options with 3 days to expiration. And we can look at the 575 put option, which is currently trading for 40 cents. So it's almost worthless because it expires in 3 days, and NVIDIA is at 622. So what I can do is I can right click on the price of this 575 put, and I can click view option in chart. Now notice that NVIDIA is up $15 today, and a couple days ago it was at $575. So let's go ahead and see what happened with this 575 put option that expires in 3 days. So if I click view option and chart, we can see the price of this put option. And as we can see here, a couple days ago, this put option was trading for $30. And a few days before that, this put option was trading for $75, which in actual value terms is $7,500. So when we look at this price of this put, we have to multiply it by 100 to get its actual dollar value. So on March 25th, this put option was trading for $7,500. And then a couple days ago, it was trading for $3,500. And now it's trading for 40 cents. And so if you bought this put option a few weeks ago, or a few days ago, I should say, you have lost basically 95% or more of your money because you bought a short-term option and the stock price moved against you, and you basically lose all of your money instantaneously when that happens, because the option doesn't have that much time before expiration. And if the stock price therefore gets too far away from that option strike price, it becomes very unlikely that that option will have any value at expiration. And so basically it loses all its value very quickly. So to explain it differently, the reason that this 575 put is worth 40 cents, and basically that means $0, is because it has 3 days to expiration. NVIDIA is currently at $620, which is $45 above the put strike price of 575. And so with 3 days to go, NVIDIA has to fall $45 or more in just 3 days by the end of this week for that put option to have any value when it expires in 3 days. And since there's such a low probability that NVIDIA will fall $45 in 3 days, that put option's price reflects that probability, and that's why that put options price is $0. So the reason I like trading longer term options, such as the positions I'm going to show you right now. So in NVIDIA, I have a couple options. So we can see this column right here that's D's open, which is days open. We can see that 207 days ago, I purchased the 700 call option in NVIDIA, and I did a long-term expiration cycle. So currently, this option has 647 days until expiration, but 200 days ago, it had 850 days to expiration. So I bought the 700 call for $88, meaning a initial cost of $8,800, and now it is trading for just under $10,000. So I've held this option for 200 days, but I'm still up money on it because I gave myself enough time for NVIDIA's stock price to increase. So we can see that over the past few months, NVIDIA really hasn't moved that much. It's been in this range. And so even with NVIDIA not really skyrocketing too much, we can see that I'm still profitable on this position because I gave myself enough time to be right about NVIDIA going up. And so when you trade short-term options, it's much closer to gambling because when you're trading short-term options, there's no margin for error. You have to be right about the direction that the stock price goes, and you have to be right about it happening in a few days or a few weeks. Otherwise, you're going to lose all of your money in those short-term options. And that's why it doesn't surprise me when Mango says they've lost so much money trading short-term options, because everything has to go right when you're trading short-term options. And you have to be right about that short-term prediction, which is very difficult to do in the stock market because things are so volatile and so unpredictable. Yes, Mango, you're right. The probability significantly decreases. Kurt, yes, this is being recorded, and afterwards this will be uploaded to the YouTube channel. So once this live stream is over, the video will be uploaded to the channel, and you'll be able to rewatch it at a later time. Lawful, thank you for the $10 super chat. Thanks for all your help understanding options trading. So much to learn. I still need help on spreads. I have another $60K to play with cash. Well, it's good that you have $60K and that it's in cash. That's a good amount of money. My word of caution would be if you're just starting out trading options, don't use that $60,000 and put all of that money into option positions, because part of learning is being wrong a lot of the times and losing money on the positions that you trade. So start really small with that 60 grand. You're in a really good spot that you have $60,000 to work with, because the more money you have, the easier it becomes to trade options. And by easier, I mean more conservative. It's less risky, because with $60,000, you can put $600 into an option position. And if you have the maximum loss on that position, you're only going to lose 1% of your account. Whereas if you had $6,000 and you put $600 into an option position, if you realize the maximum loss on that position, then you lose 10% of your account. So options trading and learning options trading is a game of survival, because if you blow out your account right when you start trading, then you don't have any more money to work with, and therefore you're not going to be trading, and therefore you're not going to continue learning about options. So just be very conservative with that 60 grand. Don't rush it. Just take your time, and you'll be better off for it. I'm really cold right now. That's why I'm kind of shaky. Assad says, weekly options, baby, better than casino. I've been covering up my BA loss for 2 weeks now. Yeah, so the reason people trade weekly options is for the exact opposite reason that I showed you with that put option trade, that it lost all the money. Let's go ahead and look at this 600 call option that's expiring in 3 days, and then we'll understand why people trade short-term options. So currently in NVIDIA, the 3-day 600 call option is trading for $22, which means it has a value of $2,200 per option. So let's go ahead and view this option's value in the chart. Before NVIDIA took off, we can see that this option was trading for, let's call it $2 to make the math really easy. So before NVIDIA skyrocketed in recent days, this 600 call option expiring at the end of this week was trading for $2 or $200. And now it is trading for $2,200. So the reason that somebody would want to buy this short-term NVIDIA call option is because they 10x their money in a couple days. But like I said, that only happens if you're right about the direction of the stock. So the reason that you could 10x your money in NVIDIA by buying a short-term out-of-the-money call is if you're looking at NVIDIA at 575 and then you buy the 600 call that expires in a few days and you pay $200 for that. And then you're lucky or you're right about your short-term prediction, NVIDIA skyrockets, and now you have a 10x. So that's why people trade short-term options, but it's highly risky to trade short-term options because you need everything to go in your favor. You need everything to work out, otherwise you're just going to vaporize all your money. All right, let's get started let's go ahead and actually make an adjustment. So while we're on NVIDIA, I do have a couple positions here, and actually I want to go to the other account because I do have some other options in here. So in this other account, we can see that I have two NVIDIA call options. I have the 800 strike call, and these have 650 days to go. I purchased these for $4,800 a piece based on the trade price of $47.95, and I did that a month ago. So now these options are trading for $72 a piece or $7,200 a piece, and I have an unrealized profit on these options. So what I want to do is I want to short one call option in NVIDIA at a higher strike price than 800, and my goal is to collect around $4,700. Now that's my target because since I purchased these 800 calls for $4,800 a piece, my goal is to remove the risk of one of these call options. So if I can short a call option against this 800 call option, and shorting it means I'm going to sell it without owning it. If I short a call option for $4,800, then I will effectively create a call spread with one of these two call options. And if I short a call option for $4,800 against the one that I purchased for $4,800, I will create a risk-free call spread. So let's go into the trade page. And right now we're looking at NVIDIA's option chain. And we can see that there's a little dot right here on the January 2023 expiration, which means that I have a position in here. So this is the expiration that I'm going to use because that's how I'm going to create this risk-free spread. I want both of my options to be in the same expiration cycle. So I mentioned that I want to short one call option for around $4,800. So now I'm going to look at the strike prices and look at what option can give me around $4,800 in credit if I am going to short it. And just by looking at these options, we can see that the 920 call in NVIDIA in this expiration cycle is trading for right around $4,800. Now the bid price is $47.30 and the ask price is $49.75. So the bid-ask spread of this option is $2.40. And that's going to be common whenever you're looking at an expensive option because the more expensive an option is, the wider the bid-ask spread is going to be just because it's a way more expensive option. So if you had like a 1% bid-ask spread on a $1 option, then the bid-ask spread would be 1 penny. But if you have a $10 option with a 1% bid-ask spread, then the bid-ask spread would be 10 cents. And then if you have a $100 option, 1% of that would be a $1 bid-ask spread. So the more expensive an option gets, naturally, the wider the bid-ask spread is going to be. So I'm going to short one of these 920 call options. Now, you may notice that the open interest is 130, and that's okay. There's generally not a ton of trading activity in longer term options. And generally you'll hear people say that you should only trade liquid options, but rules are meant to be broken. As long as you know what you're doing and you're comfortable breaking that rule. And since this is a stock that's so popular like NVIDIA, I'm comfortable trading these options. So I'm going to go ahead and initiate my order to short one of the 920 calls. And my goal is going to be to collect the mid price or maybe a little bit better. So to short an option, you click on the bid price. So I'm just going to click on the bid price. And now this queues up an order to short one of the 920 call options in NVIDIA. And automatically it brings up the mid price. So we can see that the mid price is $48.50. Since this spread is $2.30 wide, what I'm going to do is I'm going to try to short this option for slightly higher than the mid price, which would be a more favorable price. So whenever you're buying an option, generally you want to pay a lower price for it. And therefore, if you're buying an option and you want to get a better price than the mid price, a better price than the mid price when you're buying an option is to go a little bit lower than the mid price. When you're selling an option or shorting an option, if you want to get better than the mid price, then you go a little bit higher. And so we can see that this bid-ask spread is jumping around quite a bit now. So let's just go ahead and try to sell this for, let's go for $50. So the bid-ask spread is $47.70 by $51.15. I'm going to try to short this for $50. I do not anticipate that I will get filled on this. So I'm going to hit review and send. And this is an important point here. So right now, I'm trying to short this option in this account that is designated by this orange dot. And if you're colorblind, I'm sorry, but these three accounts have different colors associated with them. This middle one is purple. This one that I'm actually trying to trade in is orange. So the platform defaulted to making the trade in a different account than I actually want to trade in. So I need to specify that I'm trying to make the trade in this account. So this is the correct account now. So I'm going to go ahead and try to short this for $50. So I'm going to send the order. And as we can see, it is not filled. So if I go back to the positions tab and I go to NVIDIA, we see that I have a working order to short the 920 call option for $50. So it says LMT. This means limit. This is indicating to me that I have a limit price of $50, which means I will not actually sell this option unless the order can be filled for $50 or better. And since I'm selling it, better would be higher than the limit price. To the left of that, we can see that the mid price says $48.85. So since the mid price is $48.85 and my limit price is $50, I'm trying to sell higher than the actual mid price, and that can be more difficult than trying to sell lower than the mid price. So I'm going to go ahead and adjust this. Click. So I right clicked on this. I'm going to hit replace order, and I'm going to drop this to $49.50. Now this is really close to the asking price of $49.95, and typically it's easier to get filled when you're trying to sell something if you try to sell it closer to the bid price. So again, $49.50, I'm probably not going to get filled here, but let's go for it. So I just adjusted my order once more. Now we can see my limit price is to sell this option at $49.50, and the mid price is $48.35. So again, I'm not getting filled. So I'm going to go ahead and replace this. Let's go to 49. Review and send order. No fill yet. So this is the difficulty that a lot of people have, is that they can't fill their options. And the reason that I'm having difficulties trying to fill this trade is because this is a 650-day expiration cycle. And generally speaking, there is less trading activity in longer-term expiration cycles, which means there are less potential counterparties that are able to fill my trade. And that's why the bid-ask spread is wider. That's why the open interest is lower. And if I change this EXT column to volume, we can see that there's no volume yet today. So I'm going to be the first person to trade this option today, given that I can do it at a good price. And good price is subjective, but my main goal here is to short this 920 call option for just more than I paid for the initial 800 call, which is $48. And I think I'll be able to do that. So let's go ahead and drop this to 48.50 and see how that goes. So there we go. I just got filled. I am now filled on the short 920 call for 48.50. And as I mentioned earlier, my initial position was 2 of the 800 calls that I purchased for $47.95 a piece. And since I was able to short this 920 call for 48.50, now one of these call spreads is risk-free. Another thing that this does is before I had about $9,000 tied up in this position. Well, actually, so the current value of these 800 calls is $7,200 a piece. And if we multiply that by 2, that's a value of $14,400. So by shorting one of these 920 calls for 48.50, it actually reduces my overall margin requirement for this position because I just reduced the risk of this position by $4,850. And that's because before, if I didn't have this 920 call and the 800 calls went out worthless, then I would lose the current values that they have now, which is $7,200 a piece times 2 contracts. I would lose $14,400. But since I just shorted this 920 call, if it goes to 0, I will make money on this position. And since I shorted this 920 call for $4,850, if all of these options expire worthless, then I will lose, let's just call it $10,000 as opposed to $14.5 thousand. So by shorting this call, I actually just eliminated the risk on one of these call options, but I still have profit potential to gain because I still am holding this call spread position. But I just reduced the risk or eliminated the risk on half of this position. Another thing that this does is it reduces my bullish sensitivity to NVIDIA. So if we look at the Greeks on the right side here, we see delta, gamma, theta, vega. These are the Greeks of each of the positions. And if we look at the delta of the 2 800 calls, we can see that the delta is a positive 81.6. What this means is if NVIDIA goes up $1, then this call option position, just the 800 calls, this position is expected to make about $81. And if NVIDIA falls by $1, then this position is expected to lose about $81. By shorting the 920 call, I actually added a position that has negative delta. So this means with the delta of negative 30, if NVIDIA goes up $1, I will lose $30 on this short 920 call. But if NVIDIA falls by $1, then this 920 call position is expected to make $30. And so if we look at the overall delta of this NVIDIA position, it is 51 as opposed to before where it was 82. Because if we pretend that I didn't have this 920 short call right now, then my position delta would just be whatever the delta of these long calls is, and that's 81. And so by shorting this 920 call, I reduced risk and I also reduced my directional exposure to NVIDIA by reducing my positions delta from 81 to 51. So now this NVIDIA position overall is expected to make or lose about $51 for a $1 change in NVIDIA's share price, which is less risky than making or losing $81 for a $1 change in NVIDIA. So that wraps up the first portion of the live trading section. I hope that was helpful. Man, Lynn, thank you so much for the $49 or $49.99 super chat. I appreciate your support. Thank you so much. Manlin says, can you make a Bitcoin video soon, please? How to trade in details. It's funny you ask. Yes, I'm going to do exactly that. Pierce says, isn't this called a ghetto spread? Yes, it is. But that was coined by a different channel, and I don't use that name. But they call it a ghetto spread because you're basically legging into a call spread for no money. So basically you pay $5 for an option. that option increases in value, and then you short a different option against it for $5, and your net entry cost is 0, and so you turn it into a risk-free spread. All right, so the next thing we're going to look at is, so someone asked, can you talk about choosing a strike price, or do you have a video on that? So I just did an example of choosing a strike price, and I chose the 920 because it was worth more or just about the same as my entry cost for this 800 call. And so my goal was to take the risk off of one of these call options, and that's why I shorted one of the 920 calls for 48.50. And since I purchased these 800 calls for $47.95 a piece, by shorting one of the 920 calls, I basically removed all of the risk from one of the call positions. But I still have one call option here that is risky. So I did not spread off both of them. I spread off half of it just to not be too aggressive in adjusting this position. Because if I were to spread off both of these and NVIDIA keeps going up, then I will make a lot less money compared to what I did here, which is only spreading off one of them. So it's a conservative adjustment because I still have one of these call options that has unlimited profit potential to the upside. But if NVIDIA keeps going higher, then I'll be able to do what I just did here, but I will be able to short an even higher strike call for $48. So we'll see when that happens. Thanks, Drew. Great to hear from you. I hope you're doing well. And thanks for tuning in. I appreciate it. Give me a call anytime you want. Happy to help you out. But other than that, let's regroup in real life very soon. Jackie Yap says, what is the worst scenario for this call spread that you've just done? The worst case scenario is if NVIDIA is below $800 a share in 650 days, and I am still holding this position, then all of these call options will expire worthless. So that means, based on current prices, I will lose $7,300 a piece on the 800 calls. And since I have two of them, that would mean I would lose $14,600. But on the short 920 call that I just entered, I will make $4,980. So overall, I would lose slightly less than $10,000 if I was holding this position in 647 days and NVIDIA is below 800. But my goal is to have NVIDIA continue to increase, and then I'm going to spread off the other call option. Meaning I'm going to do the exact same thing I just did, except I'm going to use a higher strike call option, hopefully, and collect $48 or more. If I were to sell another 920 call right now for $48.50 and then all these options expired worthless, I would actually, well, I wouldn't lose any money based on the entry prices, but I would lose the unrealized profit that I have right now. So that would be the worst case scenario. And a general theme that I love about this strategy is that if you do this strategy and you're able to successfully spread off or create a risk-free spread, the worst case scenario is that you're back at square one and you don't lose any money based on your entry prices. The only thing you lose is unrealized profit, but you don't lose any principal or original account value by doing this. And so that keeps you in the game longer. Remember earlier I said options trading is a game of survival. By doing something like this, you're increasing your chances of survival dramatically, because if I were to spread off both of these call options and take all the risk off the table, then worst case scenario is that both of these options expire worthless and I don't lose any money based on the entry prices. I only lose the unrealized profit. But by making sure that I don't lose any money based on my original values that I put into these options, then it's basically like losing nothing. So, Warren Buffett's rule number one of investing, don't lose money. Gringo says, have you convinced Mike to go long Tesla yet? I don't know what he's doing. Honestly, we don't communicate our portfolios that often. Jeff says, weird question. How old were you when you started with options trading? Also, did you learn more by trial and error or did you go to school for it? How old was I? So this was in 2013, which means I was 20 years old. I was 20 years old when I started trading options. Currently, I am 28. And he asks, did you learn more by trial and error or did you go to school for it? I did not go to school for options trading. I did go to school for finance, in which I had a couple classes on options and futures, but that's more of an academic understanding of options and not necessarily what we're talking about here. And I definitely would say you don't need to take an options or futures course to learn how to trade options. Most of my learning came from experience. So actually trading options and seeing how the positions moved when the stock price moved, and then just observing. Observing is the number one teacher in the markets, especially when it comes to options, since there's so many moving parts. Observing can teach you a lot. So let's go to VXX. I want to talk about VXX for a second. So 30 days ago, I bought 100 of the 10 strike puts in VXX for 17 cents each. Currently, they're trading for just over $1. So the open P&L on this current position of 75 puts is a positive $6,500. So if we go to activity and we look at VXX, we can see that, what day is it today? The 13th. On April 1st, which is not a joke, by the way, I sold 25 of the 100 puts for 64 cents. So if we just do a little bit of calculation here, initially I bought 100 of the VXX puts at the 10 strike expiring in May, and I paid 17 cents each for those. So 17 cents means $17 each. And so that means I paid $1,700 to enter this VXX put position. Now this is a speculative trade, and I was speculating that VXX was going to lose a lot of value because at the time, let's see if I can go 30 days back. Today's the 13th, go to March 13th. 30 days ago, the VIX index was around 20, but the near-term VIX futures, which is what VXX tracks, those futures were at like 24 or 25. And what that means is VIX futures are always converging towards the VIX index. And if the VIX is lower than those VIX futures contracts, then as time passes, those VIX futures contracts are going to steadily lose value as they converge towards the VIX index. And VXX tracks the daily percentage change of these first two VIX futures contracts. So if they're steadily losing value, that means each day they have negative percent returns. And since VXX tracks the daily percentage moves of those VIX futures contracts, then VXX will have negative percentage returns, given that that relationship stays true. So my thesis for this trade was that the stock market was going to remain in a low volatility state and maybe increase, which is exactly what happened. If we go back to March 13th, we can see that the S&P 500 took a little bit of a dip, but then ultimately it was trending higher. Guy Radara says contango, exactly right. So what I did with VXX around, where was VXX on March 13th? VXX was around 13. So what I did was I bought 100 of the 10 strike puts in VXX that were expiring in about 60 days, a little bit longer than that. And I paid 17 cents each for these. So my initial outlay was $1,700. Now, if I look at the trade that I made on April 1st, we can see that I sold 25 of the puts. So I closed a quarter of the position for 64 cents each. So if we look at that math, $64 collected for each of these contracts times 25 is $1,600. So my initial outlay was $1,700. And then after the VXX puts had expanded in value, since VXX was going down, I closed a quarter of the position for $1,600. And so basically I took all of my risk off of the table. But right now what I'm going to do is I'm going to close another portion of this position. I'm going to close another 25 of these for $1 each. And by doing that, I will effectively, let's do some math here. Well, actually, let's close 25 of these. So I want to close another 25 of these puts, and then I'm going to let the other 50 ride, and we're going to see what happens. So I'm going to take all my risk off the table. Well, I've already taken basically 100% of my risk off the table, since initially I paid $1,700 to get into 100 of these puts, and then I closed a quarter of them, collected $1,600. So basically my cost of this position is about $100. So let's close another 25 of these and then do some math to see what my returns are, and then talk about what can happen in the future. So we can see that on VXX, the bid-ask spread is very narrow. So it's $1.03 by $1.05. So I'm going to go ahead and just try to sell these right at the mid price, and I'm making sure, again, it's in the right account, and I'm going to go ahead and click sell. So we can see that I'm trying to sell 25 of these puts, but the asking price is 104, and I'm trying to sell at 103, which is the bid price. Or actually, I'm trying to sell at 104, which is the asking price. So if I were to drop this order to 103, I'll get filled instantly on this trade. And so since I just want to get out of this and it doesn't matter, I'm just going to drop this to 103. And since that's the bid price, I will be filled on these right away. So there we go. So I just closed another 25 of the VXX puts. And now I am holding 50 of them, and I'm just going to let those ride. So let's go ahead and look at what I just did. So we can see on March 15th, I purchased 100 of the 10 strike puts in VXX for 17 cents each. So that means I paid $1,700 to get into that position. And then on April 1st, I sold 25 of the 100 for 64 cents each. So 64 times 25. That means I received $1,600 back into my account. And since my initial outlay was $1,700, if I pay $1,700 and then later receive $1,600, that means I only have $100 of risk in the game relative to what I paid and received for those two trades. But right now I just sold another 25 for $1.03. So 25 contracts times $103 a piece is $25.75. But we just discussed that prior to this transaction, I had $100 in the game. And so what that means is my profit is $24.75 on an initial outlay of $1,700. So I doubled my money. I'm just trying to make sure I don't misspeak here. I doubled my money because I collected $1,600 plus, let's just call it $25.75. I collected $4,175 into my account, but I paid $1,700 initially. So I made double my money on this transaction, but I've only closed half of my position thus far. So what I'm going to do, since these options have 40 days to go, is I'm just going to let these 50 contracts ride. And let's say VXX gets down to $8. If it gets to $8, then these 10 puts will be worth $2 a piece, and therefore I'll be able to sell the remaining 50 of them for $10,000. So it'll be a really big winner if that happens. But worst case scenario is VXX goes up and these puts go out worthless, and then I lose the $5,000 of value that exists in them right now. So that's just another way that you can manage a position without closing the whole thing, and you can still let some of it ride. Because at the end of the day, if I can take all my risk off the table or more, and then still hold a position that has lots of profit potential, then that is a long-term recipe for making lots of money trading options. Because the number one rule is to not lose money. But if you can create positions where you take all your risk off the table and guarantee that you actually don't lose any money based on your initial values, or something like this where I've doubled my money in the initial position, but now I still have half the position that can still make even more money, that's going to be a good recipe to follow long term. Now you will notice that I do have these 25 puts or 25 calls that expire in 283 days, and these are at the 50 strike, and I paid $2 each for these. So right now this position's down about $3,000, but these are different positions here. I didn't put these on as sort of a strangle. This is a market/portfolio hedge, and this was more of a speculative trade based on my thesis that VXX would lose value due to the low VIX index and potentially lower VIX index, while the VIX futures were at a significant premium to the VIX index, which is called contango, as Guy Rodar said. So I hope that was helpful as well. So we've gone through 2 trades thus far. Let's see what else we have. We have Square. So in this account, I do have some call options in Square. I have the 290s that I purchased for $29.50. Now they're at $62.60. Excuse me. And I have 2 of the 360s that I purchased for $29, and now they're at $40. So actually, I'm going to go ahead and let's go ahead and look at Square. What can I do with the Square position, and can I sell 2 call options in Square in the 650-day expiration cycle and collect $29.50? Because as we did earlier, if I can sell 2 call options in Square that have a higher strike price than $290, and I can collect $29.50 for them, then I will take all the risk off of the table for these 2 call options specifically. So let's go see what we can do here. So what options are trading for $29? Well, we could see that we can go to the 420, or the 400 would be the closest, 400 or 410. But if we look here, we can see that the open interest is 422 contracts at the 400 strike, 39 contracts at the 410 strike, and 4,000 contracts at the 420 strike. So getting back to strike price selection, somebody asked earlier, how do you choose strike prices? Liquidity, or how much trading activity is in a strike price, is one really good way to choose strike prices. So an example would be if I was looking to buy an option in Square, instead of choosing the 340 call, which has 55 contracts of open interest and 100 contracts of volume, instead of buying the 340 call, it would be much better for me to buy the 350 call, because they basically have the same price. We're talking about spending $4,500 versus $4,300. It's basically a rounding error. But the benefit of the 350 call is that the open interest is 5.1 thousand. So that means there's 5,000 contracts that are open between 2 parties at the 350 call in Square, as opposed to the 340 call, which only has 50 open contracts. So I strongly prefer any strike price that has higher open interest, because if you're looking at adjacent strike prices, you should basically always choose the one that has higher open interest, because since there are more open contracts, then it's just going to be a better time in terms of getting filled on a trade. So I'm going to go ahead and short 2 call options against this position. And for the reasons that I just discussed, I'm going to use I'm going to use the 420 call option. And I know that I'm not going to sell it for $29.50, which is my entry price on these two 290s, but I'll get close enough, because the goal for me is not necessarily to make it a risk-free trade, but basically take most of the risk off. So if I can get close to $29.50, that's good for me. I don't need to get exactly $29.50, but if we're trying to have a textbook risk-free trade, then I would need to short two call options at a higher strike price than $290, and I would need to collect $29.50 for them. So I don't need to get $29.50. I just want to get close and take some risk off the table, because knowing that we've seen pretty insane movements in the stock market, and especially with Square getting up to its prior all-time high, I want to take some risk off of this Square position. So I'm going to go ahead and click on the bid price of the 420 call, and I want to sell two of them, not just one of them. So if I sell two of them, I have to increase my quantity to two. The mid price is currently $27.50, and let's go to $27.60. So just a couple ticks higher than $27.50. What I want you to notice here is it says my buying power effect on the right-hand corner here for shorting two of these options is a $5,520 credit. What this is telling me is that if I short these two options, it will actually relieve margin requirement from this position, because I currently have risky positions in Square. So since I have two long call option positions in Square, my current value of these options is $20,000. And that's indicated by this net lick column. Net lick is net liquidation value, or how much cash you could convert this position into if you were to liquidate it or close it right now. So since my net lick value in Square is $20,344, that means if all of these options expired worthless, then I would essentially lose $20,344. So if I am to short two of these options, I am actually going to reduce my risk in this position by the total value that I bring in from shorting these two call options, and that will actually reduce my overall risk, and therefore it will release margin requirement back into my account, since I am taking an existing risky position and reducing the risk or maximum loss potential on that position. So this has changed a little bit from the last mid price we were looking at, but let's go ahead and try to get filled at 27. Let's start higher and work our way down. So one thing you want to do when you're filling trades, particularly in something that has a wider bid-ask spread, is try to get filled at the best possible price for you. And since I'm shorting these options, I want to get closer to the asking price of $28.05. And so based on what I just said, let's go to $27.50. So let's go ahead and try to short these. And we can see that I have a working order. My limit's at $27.50. The mid price is at $26.70. So I'm not going to get filled there. And so I'm going to go ahead and reduce this to a lower price. Also, if we go and look at the bid-ask spread of this 420 call, now we can see that the asking price is $47.50. So I actually changed the bid-ask price based on my order. And so that's going to significantly reduce the mid price, which means I'm going to have to lower my price even further to try to get filled on this. So I'm going to go to 27, and I just got filled at 27. So I'm completely happy with that. I know I changed the order price by $50 there, but when we're talking about a position that is $2,700 a piece, and you change your order price by $50 relative to $2,700 isn't really that much. So what I just did here is I reduced the risk of my overall position by shorting two of the 420 calls for $27 a piece. And so you could technically look at these short 420s as being the short calls or against the 360s or the 290s. I'm personally looking at it from the perspective of I have the 290 420 call spreads, but you could also say I have the 360 420 call spreads. since I have 4 total calls and 2 short calls. So as I was talking about earlier, if we look back at the net liquidation value of my square position, before it was at $20,344. And now the net liquidation value is at $14,934. Now what this means is my risk in this position is $5,000 lower than it was before. So if all these options go to zero, instead of losing $20,000, I will lose $14,900, which is a lower risk position. Also, I didn't point it out earlier, but the option buying power also went up, which means that by doing this trade here, I actually increased my available buying power for other trades by the amount that I collected, which is $5,344. Sorry, I got to get rid of some spam here. One second. All right, so we've done a bunch of trades thus far. We've done some long call leaps adjustment trades, and then I also took risk off the table in VXX. But yeah, that's what I want to cover today. Thought it would be fun to actually do some live trades. Now I'll just open it up to Q&A, and we'll hang out for a little bit. Jay Kong asks, do you have a day job? No, this is my job. YouTubing is my full-time job, and feeling super blessed to have that. But I will say I started in 2016. 2016 is when I quit my day job, and I started the website and the YouTube channel, and it's 2021 now, so we're coming up on 5 years of me doing this, and the first 2.5 to 3 years were very difficult. I made barely no money, and it was just a struggle because I was putting in a ton of work, probably more work than I am putting in now, and I wasn't getting any reward for it. And there were many times along the way where I wanted to give up and I wanted to quit. And there was actually a time when I was applying for other jobs, and I thought that people would not hesitate to hire somebody who took the initiative to quit their job and try to start something of their own. But to my surprise, I didn't get any of the jobs that I applied for. And so I kind of just channeled that energy and put it back into YouTube and put my head down, continued to work, and fortunately things worked out in the end. And I'm actually glad that I didn't get any of those jobs in hindsight. But yeah, this is my day job, but as I just said, took a few years of lots of work and very little reward to make it happen. Jay Kong asks, I'm trying to move away, or he says, I'm trying to move away from the 9 to 5. Yeah, so I think a very basic template for moving away from a 9 to 5 is, first of all, if you're going to start something of your own, you need to have some sort of knowledge or expertise, and you can get that from a 9 to 5 job. So what I did is I worked at a company for 3 years learning about options trading and learning about the markets, and that was my day job. And then after those 3 years, I was just confident enough with what I knew to go off on my own and start something of my own. So a very basic template to follow is you have to go through working for other people first to build expertise and knowledge. Not always, but in most cases, that's what you're going to have to do. And then once you figure out what you really want to do and you get that knowledge and expertise, then you can branch off and go off on your own. It's a very classic path for a lot of people that are entrepreneurs or do something on their own, is they first work for somebody else and get experience and knowledge. And then once you have that, then you are more confident and you're in a better position to go off and do something on your own. Like if you want to start a clothing company, it would be extremely helpful to work for a clothing company, especially if you can see the business on the back end and you can see, how the manufacturing process goes and how the logistics go in terms of actually fulfilling and then shipping out those clothes, and maybe get familiar with the software that they use. Maybe they have a Shopify store where they sell the clothing. And if you can work for a company like that and you can get experience with all those different areas within that business and you can see on the back end how it works, then you're in a position where you know exactly how everything looks and how it works. And then if you wanted to go off on your own and start a clothing company, now you're equipped with all those skills to actually use what another successful clothing company is using and apply that knowledge and experience to your own thing. So that's how I think a lot of people would go from it or go about it. Derek says, did you start from cold and no knowledge in 2016? No, I started in 2013 in the options market, in the stock market, and for 3 years straight, it was my full-time job to essentially learn about options, teach other people about options. And then after 3 years of getting knowledge, as I just described, I was in a position where I was super confident in going off and starting something of my own. Thank you all for the support. I really appreciate it. Someone says, hi from Sabah, Malaysia. Is that how you say it? Hi from Malaysia. That's all I know. Hamzeas says, can you tell us how to add the open interest and how to edit the option columns? Yes. So that's a good question. So on tastyworks, someone noticed that I changed these columns. So if I open up this option chain right now we're looking at square options, but that really doesn't matter. You'll notice that we have 4 columns here. We have the bid ask. So this is the bid and the ask price of all these options. We have calls on the left, puts on the right. But then there are these 2 columns here that you can change. And all you do to change these columns is click on it. So right now, I basically always have open interest open, and I have volume open as well right now. But let's say I want to change volume to, delta. This is a pretty common setup for me, is open interest and delta. So basically you just click on the column and then you change it to whatever you want. So super easy. JC says, what's a good amount to start with for an initial investment, wanting to make around 1K weekly? So a lot of people come into options trading and they have return targets, especially like weekly or monthly. And I think that's a very difficult way to go about options trading, because the stock market is so volatile and unpredictable that because it's so unpredictable and volatile, it's also very unpredictable and volatile in terms of your profits and losses. So to come in and say, I want to make $1,000 a week, unfortunately, that's a very difficult thing to do, because the markets are so volatile, and maybe one week you make 2,000, maybe another week you lose 1,000, maybe one week you don't make anything. So it's very hard to have a very systematic return when it comes to the stock market, because things are moving around every single day, and based on that, your positions are making or losing money every single day. And so it's very hard to come up with a consistent plan to make X dollars per week or X dollars per month. But in terms of starting, I would say at a bare minimum, you need $2,000 to open a margin account. But I think the more money you have, the easier it is to be conservative, because you can put money into a position and it would take up less of a percentage of your account. So earlier someone said they had $60,000 to work with, and I use an example. If they put on an option position with $600 of loss potential with $60,000, then that one position is only risking 1% of the account. Whereas if you have $6,000 and you put on a position with $600 of loss potential, then you have 10% of your account at risk in that one position. So more is better, but $2,000 is the bare minimum for a margin account, which you need for most option strategies. $5,000 is an even better starting point, but I think that like magic beginner number for being able to trade options conservatively based on the amount of risk that you can put into one position, I think is around $10,000. So I think $10,000 is a really good goal. But again, as I said earlier as well, when you're first starting out, it's actually better to have less money that you're using to trade options, because if you're learning to trade options with $1 million, you might lose $1 million if you do something wrong and you're sizing all your positions based on that $1 million account. Whereas if you're learning options with a $5,000 account and you blow that up, you only lose $5,000. So I think the more money you have available to you, I think you should be very, very, very careful with how much money you actually use to trade options and learn, because there's a lot of things to learn about options before you can trade them safely and understand the risks of what can go wrong. And when you're starting out, you're going to be experimenting a lot, and therefore you're going to be losing a lot of money on a lot of different positions. So I would say more is better in terms of your ability to risk a smaller percentage of your account, but more is actually worse also, because if you have $100,000 and you're starting to trade options and you're learning options with a $100,000 account, then you might get tempted to risk higher dollar amounts on each options position, and therefore you could lose a lot more money. So I would say $5,000 to $10,000 is a good starting account value for learning options. I don't know how to say your name, but Mikey, is that how you say it? Mikey Stonks? Majki Stonks? Thank you for the super chat. I appreciate it. He says, hi, is tastyworks good for stocks as well? Because I would like to have like 70% long-term stocks and mess with 30% leaps or something like that. Thank you. I really like your approach. So they're saying they want to have 70% of their account long-term in passive stock investments, and then they want to use the other 30% to mess around with leaps or something like that. So I think that's a great strategy, and that is pretty aligned with what I foresee my future with options trading to be, is something like over 50% in passive investments, and then a smaller percentage using that smaller percentage for higher risk stuff, such as buying leaps or short-term options trading strategies with lots of reward potential, but higher risk and lower probability of retaining value as compared to a long-term passive investment like stocks. So yes, I would say tastyworks is good because you can trade stocks for free. So if I go ahead and queue up this order to buy 100 shares of Square, we can see that the commissions, it says 0, estimated fees is 8 cents on 100 shares of Square, and 100 shares of Square at $270 a share, that's a $27,000 position, and paying an 8-cent fee on a $27,000 position, that's basically free. So yeah, they do have free stock trading. These estimated fees are regulatory and exchange fees, if I'm not mistaken. But like I said, it's basically 0. So yeah, tastyworks is great if you want to do basically exactly what I'm doing. If I look at these columns here and I uncheck some of them, so if I uncheck options, we can see that these are just stock positions. So all of these positions here are just buy and hold stock positions. But then if I enable options again, it will show me my option positions as well. So we can see that I do have some option positions, but a majority of it is long-term passive positions in shares. So I think tastyworks is great. By the way, if you're watching this right now, there is a link in the description. Tastyworks through June 31st is doing a crypto giveaway. So if you are a new customer and you open and fund with tastyworks and you use the link in the description, you can get up to $200, I believe, in free crypto. and you can choose between 4 of the primary cryptocurrencies. So if you're interested in that and you need a brokerage firm, check that out. But by no means is that a hard sell. I think everyone should do the research and pick what brokerage firm they think suits them the best. Sorry, I'm catching up here. Ask me questions. Let's see. Wowzer says, don't get demotivated as it's a learning process. Yes, exactly right. So you should go into options trading with a long-term mindset. It's just like anything else. The more you put into it, the more you're going to get out of it. And it takes a lot of time to learn this stuff. Like, people have spent their whole lives in the markets, learning about the markets and learning about options. I've spent the last 8 years learning about options, and it's definitely a marathon, not a sprint. And also what I will say is, even though I kind of just touched on the fact that most of my investments are passive and I use a smaller percent, less than 50% of my accounts for options trading, that doesn't mean I don't believe in options trading. What it means is that I believe more in preserving value in passive investments, but I definitely have a place in the portfolio for options, and it will always be a part of my investment approach and my trading approach, I should say. But at the end of the day, options take a long time to learn because they are complicated at first. There's a lot of things that you have to wrap your head around, and there's a lot of moving pieces. So definitely take your time. It is definitely a valuable thing to learn, as we can see just based on these P&Ls that are in these accounts over the past year, or just this year, I should say. But speaking on the current state of the markets, like, in the future, there may be times where I'm more heavy into options and times where I'm less heavy into options. I think right now is a time where I am somewhat backing off and not taking as much risk, just because we've had these insane movements in the markets over the past couple of years. So, like, the economy is not even opened up fully again. And before the coronavirus hit, we can see that SPY was around $340 a share. And now the economy is not even reopened yet. And now SPY is at $412 a share. So the markets are way higher than they were before the coronavirus even hit. And the economy is less open than it was before the coronavirus hit. And so I think a lot of these stock price movements are, they're pricing in the growth that's to come when the economy does reopen. And I actually also think that this is inflation happening right before our eyes, just because so much money is being printed by the government. And so naturally that money flows somewhere. And if people fear inflation, then they're not going to hold cash, because if they believe that high inflation is coming, then that means they believe that cash is going to lose value very quickly. And so they put all that money into riskier assets that are going to keep pace with inflation. And so I think that is exactly what we're seeing here. And just based on all the movements that we've seen recently, I'm kind of backing off of the upside speculative investments, or trades, I should say, such as these long-term leaps calls. And that's exactly why today I took some defensive measures and actually took some risk off of the table, but not all of the risk. So to end that little rant there, definitely keep a long-term focus when you're learning about options. It's a very valuable skill to learn. It's very valuable knowledge to have. Knowledge will never hurt you because you don't have to always use it. And I've said this before, but I've recently been making a comparison between options trading and a car. Like, my car serves a very important purpose and it's very valuable to me. But just because I have the car doesn't mean I'm driving around in my car 24 hours a day. I use it when I need it, and when it serves a very specific purpose. And I see options the exact same way. Just because I know about options, it doesn't mean that I'm going to forget about all of the other things that I can do with my money and just focus on options, because I see options as having a very special place and in very specific scenarios, and they can be used very strategically. But just because they're there, it doesn't mean that I need to sell all my stocks and sell all of my investments and put 100% of my money into option strategies. So yeah, it's very valuable to learn. It will never hurt you, and knowledge is power, especially when it comes to money. So keep it up, everybody. Talia, thank you so much for the super chat. I read that Warren Buffett has averaged 25 to 30% compound annual growth rates over his career. Is it possible to consistently beat that return with option strategies like iron condors? So when you talk about investment returns, one thing that's overlooked is with options, you can have triple-digit returns per year if you are hitting home run trades, or you can even have 30% returns, 40% returns per year if you're really good and you're really good at managing your risk and you make a lot of successful predictions. I'm not saying that's likely, but another thing to keep in mind is returns are always adjusted for risk in the investment space. So if you compare a 30% return in the S&P 500 to a 30% return in your options account, it's not necessarily apples to apples, because if you made a 30% return in the S&P 500 and the volatility of that investment is really low, but you made 30% returns in your options account, but maybe you were down 80% overall early that year, and then you ended up 30%. You made 30%, but you had way more risk in terms of volatility. And so your risk-adjusted return is probably way worse than the 30% return in the S&P 500. So whenever we talk about returns in investing, we always have to factor in the volatility and the risk that was taken. Getting back to your question, do I think that it is possible to consistently make 25 to 30% returns? I would say it really depends on your strategy, and the most important thing is not having catastrophic losses. The problem with iron condors is that if you're shorting iron condors, you have more loss potential than reward potential. And because of that, you have to be very, very active and very diligent with your losses, and you can't have your losses get out of control. Otherwise, it's going to be very, very hard to make money over time, since with a short iron condor, your profits are smaller than your losses or your loss potential. And so it's possible, but I think you're going to have to risk a large percentage of your account in those positions to make 25 to 30% per year selling iron condors. So like I said before, you can do it. It's just going to require a lot of risk. And in investing, we always compare the risk of an investment or the volatility of an investment to its returns. It's always the returns relative to the volatility. And then that gives us something called a Sharpe ratio, which is basically the returns adjusted for volatility. So ideally, you have higher returns than the market with the same volatility as the market. That will give you a very attractive investment profile or Sharpe ratio. Any more questions? I got time. I'm just hanging out. Just looking for some questions here. Robert Mosher, thank you for the $5 super chat. I appreciate your support. Thank you so much. I like trading options than trading stocks for risk-reward ratio, but it's risky. I hear ya. What is the best approach of options trading, bull call spread in bull market or bear call spread in bear market versus doing covered calls and naked puts? It's always impossible to say what a best approach is for options trading just because there's so many different strategies, but more importantly, with the same strategy, there's a million different ways to manage that strategy and size that strategy. So I can't say what's the best approach, but for me, it always comes down to what's your prediction for a specific outcome and what do you want in terms of risk to reward? So like if you have a specific prediction, do you want to have a lot of profit potential and a little bit of risk? So which would be the case if you're like buying options or something. If you buy a call, you have limited downside risk and lots of profit potential, but that requires a very specific outcome. Versus what you're saying, if you instead had a bullish outlook and you sold a put spread, if you short a put spread, then you have limited risk, or you have limited reward and even more risk than reward. So it's a higher probability strategy. So it always comes down to what's your prediction for something and how aggressive are you, or how much conviction do you have with that prediction? And then that will inform you of what option strategies to choose from. But it's really impossible to say what's the best approach given X and Y. Alex Smith, did I miss you? He said he sent a super chat. Sorry, Alec. Alec, thank you so much. Thank you so much for the super chat. Sorry I missed you. I was ranting for a while there. What advice do you have for a beginner options trader with a small account, $2,500? What time horizons to play? How far in the money or out of the money is best? And tickers. That is a phenomenal question, Alec. Thank you. So, as a lot of people have mentioned here, and as we talked about earlier, if you're just getting started with options, in terms of time frame, I would avoid weekly options because weekly options are very binary, meaning that you make or lose money instantaneously, and it's the easiest way to lose money very fast. So my advice in terms of time frame would be to stick to like 30 to 60 days. So like if I was in Square and I wanted to make a bullish trade in Square with $2,500, hold on. Let's just see. So let's say I was bearish Square. Like I think Square is approaching its previous all-time high, and I think it's going to go down from here. So maybe I go out to this May 2021 expiration cycle and I sell the 280 call and buy the 290 call. Now this is actually a pretty large position, and for that reason I'm going to change it because the max loss of that position was $700, and I think that's far too much for having a $2,500 account. So let's flip the script a little bit. Let's say you're bullish on SPY because you think inflation is here to stay and you think that all the money is going to continue to pile into the market. Let's say you wanted to put on a bullish trade with $2,500 in your account and you wanted to trade SPY. What I would do is I would go to like the 30 to 60 day expiration cycle. Let's say for this one we're going to do May 2021, and let's say you're going to sell an at the money spread. So maybe you do the 410 405 put spread, and in this case we can see that the max profit is $151 and the max loss is $350. So maybe based on that risk to reward profile, maybe you're not interested in this put spread or selling this put spread because you have more loss potential than profit potential. And in a $2,500 account, you're really trying to limit your losses, and you're really convinced that the market is going to continue going higher. So maybe you do the 410, 415 call spread. And in this case, you have $290 of risk. So maybe let's even move the strike prices to the 411, 416. And now it's basically the same. So instead of doing this $5 wide call spread, maybe you do something that is a little bit more narrow. So let's look at a 411, 414 call spread. And let's say you want to do this. I think this would be a really good starting trade. With $2,500, a max loss potential of 175 is, it's less than 10%, but it's still, multiple percentage points in terms of risk. So it really depends on how much you want to risk. But in terms of time frame, I would definitely go 30 to 60 days. And for each option position, I would target risking less than 10% of your account. And even so, like if you were to put on this trade, I would probably recommend having some sort of stop loss with this. So if you put on this spread and it falls to, let's say $100, maybe you take the loss there, or even just take the loss on this spread and then adjust the strike prices lower so that if the market rebounds, then it'll actually be through your spread as opposed to getting back to your previous strike prices, which are higher. So I don't know. It's really hard. I'm not going to try to outline a strategy for you. But in terms of time frame, I would definitely stick to 30 to 60 days. And then in terms of strategies, I would stick to vertical spreads for sure. So what I just queued up for you is a vertical spread. You want to stick to spreads because you'll have limited risk. And that's going to be really important with a small account because you want to have limited risk. You don't want to trade any strategy that has undefined risk or unlimited risk because number one, you will have lots of risk in that position. But number two, since you have a lot of risk in that position, it's going to tie up a lot in margin requirement, and that might not be a good thing. So definitely stick to simply buying options, buying puts, buying calls, and the vertical spread strategies. So I hope that answers your question, Alec. Feel free to ask some more questions if you have them. How far in the money or out of the money is best? That's another thing he asked. One thing about that is if you're going to buy an option, if you go in the money, it's going to cost more. So if we look at SPY and go to that May 20 expiration cycle, May 2021, if you're going to buy the 411 call, it's going to cost you $800. And if you're going to buy the 400 call, it's going to cost you $1,600. So I wouldn't necessarily recommend buying an in-the-money option, especially one with 38 days to go. I would probably stick to debit spreads in your specific case, and then I would go 30 to 60 days out. And for those spreads, I would probably stick to at the money or slightly out of the money, depending on your prediction for a certain stock price movement. But the name of the game when you're starting out is to risk small portions of your account, which is going to be harder in a $2,500 account. But then also, you just want to learn. So just observe those positions every single day as the market is moving and see why is that position profiting, why is the position losing money, and you will learn quickly. Levi asks, what's a good hedge for SPY? How do you do it? Well, a very straightforward hedge for SPY would be if you think the market is going to go down, then that would mean you want to buy a put or buy a put spread. So if SPY is at $411, it really depends on what you're going for. Some people will hedge on a weekly basis and they'll use shorter term options and go out of the money, such as, they might buy the 405 put or something that's less than the current price of 412. They'll buy an out of the money put in a short term expiration cycle because the shorter term options are cheaper than options at the same strike price and a further out expiration date. And the benefit of doing something like this is if the market absolutely crashed in the rest of this week and you owned the 405 put for 40 cents and SPY goes to $400, then this 405 put would be worth at least $5, and so you would 10x your money, and that would be a very effective hedge in that scenario. If you went out to a further further term expiration such as May 2021, if you bought that same 405 put, now you're going to pay $5 for this option, and that's much more expensive, but you also have 35 more days of protection. So it really depends on how long you need the hedge for. If you need a 3-month hedge, then you would go to something like the July 2021 expiration. But again, the options are going to get way more expensive the further out you go. So if you're going to go to a longer term cycle like this with 95 days to go, maybe you don't buy the 405, maybe you go to like the 390 and you pay $700 for this. But hedging SPY with downside puts is really expensive because everyone is long the stock market. And if we're talking about a huge fund that owns billions and billions of dollars worth of stock, the way they can hedge that is they can purchase put options in SPY. And since there's so much demand for protection in the form of downside puts in the S&P 500, then these puts get way more expensive because of that. And that actually causes something called skew. So if we look at the May 2021 expiration, if we look at the put option that's $10 below the money or below the stock price, and then we look at the call option that's $10 higher than the stock price, we will notice that the put option is far more expensive. So if we look at the 402 put, we can see that the 402 put is $4.40. So this put is $10 below the current price of 412, and this put is $4.40. If we go to the 422 call, we can see that the 422 call is $2.90. So there's way more demand for downside puts as compared to upside calls. So when you're talking about hedging with SPY or hedging SPY by purchasing out of the money puts, just know that it's going to be a very expensive position, and you have to be pretty accurate about your timing of that hedge. And if you're not accurate about the timing, then you're going to have to repurchase that hedge periodically, which is going to cost a lot of money. So for example, if I'm going to buy the 400 put in SPY this month, I'm going to pay $400 for this. If that goes out worthless, then I'm going to have to, pay $400, $500 next month. And if 12 months go by and the market is continually rising, you're going to lose $500 a month, let's say, times 12 months. That's $6,000 in hedging costs that you lost. So hedging with SPY is very expensive. Options are finicky. Yes, they are. Jacob, I didn't know you did live streams. You explained things very clearly. Thank you. Thank you, Jacob. I appreciate it. Ben says the Apple 195 Jan 23 call is doing awesome. Thanks for the help on this the other day when you were live streaming. Let's look at that. What's going on in Apple? Nice. I actually have some positions in Apple. I haven't checked in on them. Look at that. So I talked about this in a past live stream. I had these 200 calls in Apple, and I entered these 200 days ago. I paid $950 a piece for these, and currently they're at $670. But then Apple was way lower, and I had a loss on these positions, so I actually bought 5 more at the same strike price, but a little bit further out in time, and I paid $5.40 for these. And basically what that means is I have 10 contracts of the 200 calls in Apple for an average price of right around $7.50. Is that right? Yeah. And so if we look at the open P&L of these two trades, I'm down $1,300 on the initial position, but I'm up $1,000 on the newer position. And basically, because I averaged into these trades, or I bought more at a lower price and brought my average price down, now that Apple is starting to tick back upwards, I am closer to break even than I would have been if I didn't buy more of those calls. So since I had a high conviction that Apple, being Apple, since it was in a downward phase and I did have a loss on that initial call position, what I did was I purchased more to effectively add to the position and bring down my average cost on those 200 calls. So if we go and look at, if we actually go ahead and plot the price of this 200 call, then we can see it's on the up and up. And so if Apple continues to rise, then so will this long-term call, assuming that Apple continues to increase fairly quickly and it doesn't take 2 years for it to get to, whatever. But yeah, so I averaged into those Apple calls, and now I'm pretty much at break even on that position because I bought more when it was in a decline, and that's essentially dollar cost averaging except with options and then not shares. So I'm basically at break even here. And so if Apple goes back to my initial entry price, wherever it was when I initially entered the trade, then this position overall will start to be profitable overall. So that's dollar cost averaging with long-term call options. Nice job, Ben. You're doing better than me. Up 49%. I'm up 0% because I'm down a little bit of money on that Apple position. Let's see here. Kid asks, so what do you hedge with? Well, one of the positions I have right now, which is a hedge that's not doing well, is the VXX calls. So I have 25 of these 50 calls that expire in 280 days in VXX. The thought behind this is if the market crashes, the VIX index and the VIX futures are going to skyrocket, and therefore VXX will gain value as well. However, since VXX has lost considerable value since I entered this position, now I need an even bigger market crash to happen and an even bigger volatility increase to happen, because VXX moves on daily percentage changes. So basically VXX tracks the first two VIX futures contracts, and it takes a weighted average of those two to get to a 30-day VIX future contract, essentially. And then it tracks the daily percentage change in that 30-day VIX future based on a weighted average of the first 2 month VIX futures. And so the lower VXX gets, it still is going to track on a percentage basis. So a 10% increase in volatility with VXX at 10 means that VXX would effectively go up 10% or $1 if that 30-day VIX future went up 10% in one day. But if VXX is at $20 and we have a 10% increase in the 30-day VIX future, then VXX will go up $1.50 as opposed to $1. And so in hindsight, this hedge is not very effective. It was kind of a poor choice, but I'm going to continue holding it since, I bought it for $2 and now they're at 80 cents. I've lost over 50%, and so I'm just going to let these ride. And they also have 280 days to go, so you never know what's going to happen. But if we do get a pretty severe market correction and subsequent increase in VIX index and futures, then VXX will rise considerably, and then people will also start buying upside VXX calls to anticipate further increases in VXX, and we will see a surge in implied volatility or the option prices in VXX. So VXX is kind of a nice hedging vehicle because if you own upside calls, as VXX goes up, implied volatility goes up as well. So you're not only making money on the directional increase of VXX if you own calls, you're also making money from an explosion in implied volatility via demand for those upside calls, because as VXX goes up, people are going to start layering into those VXX calls to anticipate further increases, and for that reason, VXX call options explode if VXX starts trending higher and if the market starts to fall. But right now, this is a poor hedge in VXX. Other than that, I just trade around the largest positions and try to reduce the risk in those large positions as best I can. And I do that through, well, I have done that in these positions by shorting call options against the risky call options that I owned. And I turned a lot of my long calls in these long-term expiration cycles into risk-free spreads. And so that's how I hedge. I don't really like to hedge with outright hedges. I like to reduce the risk of existing positions by using options in a way that doesn't necessarily cost me money, which I've done with these spreads, but actually takes risk off the table without having this monthly rolling cost, which you would have if you were like buying puts in SPY, for example. I know that was probably pretty complicated, but that's what I'm doing. Someone says, hi, Chris, do you sell leaps? Theta decay is a lot less. Yes, I sell leaps, but only if it's a part of a spread. So as I did earlier, I shorted some of these call options in Square, and you'll notice that the positive theta of these short 420 calls is pretty low. And the reason that longer term options don't decay very fast is because they have so much time before expiration. So I don't sell options in long-term expiration cycles for theta decay. I sell options in long-term expirations to reduce the risk of my existing call option positions. But it's not a time decay or theta decay play whatsoever. When you're selling options for theta decay, you want to stick to that 30 to 60 day window. I like to go to 60 days just to kind of give myself a little more time. But if you're trading options for the purpose of collecting time decay, then you want to be in a shorter term expiration cycle, such as fewer than 60 days. Chris, what is your go-to strategy? My go-to strategy, I covered this in a live stream in the past, a couple weeks ago, but right now my go-to strategy has been buying out of the money call options in 2+ year expiration cycles or 1.5 years out or more, and buying those out of the money calls in products or stocks that I have a high conviction of seeing increases in. And then if the stock price increases and those call options start making a lot of money, as we can see here with Square, then what I will do is I will short a higher strike call against the existing long calls to create a call spread or a bull call spread. But it's a very favorable thing to do in terms of entry costs because I can effectively create a risk-free spread, meaning that the amount I pay for the lower strike call is the same that I collect for the higher strike call that I sell at a later date. And so I've done that in Tesla. We can see that I bought the 900 call here for $100, and then at a later date, I shorted the 1500 call for $117. And so I have the 900, 1500 bull call spread for a net credit. Whereas if I were to enter this trade right now, entering both the long and short option at the same time, I would pay a very hefty price for it. So if I were to actually buy the 900 call and short the 1500 call at the same time right now, I would pay $9,800. As opposed to my entry prices, which were at different points in time, I actually entered this trade for a credit of $1,700 as opposed to paying $9,800. And that's because I bought the 900 call 200 days ago, and then Tesla increased dramatically, and then 41 days ago, I shorted the 1500 call. And I actually shorted a call against it, and then I bought it back when Tesla went down, and then I re-shorted it and basically made $10,000 on that trade. And now, as the position stands, I have a $1,700 credit on this call spread. So there's no risk here. Chris, do you day trade? No, I don't day trade. I do longer term stuff. I don't like to day trade because I don't want to sit here and watch the positions all day long. When you're day trading, your positions are hypersensitive to changes in the stock price, and so you have to be watching it all day long. Whereas I prefer to put on positions that have a little more stability, and I don't have to watch them like a hawk. And I can just check in periodically and know in my head that they are longer term positions, so I don't have to sit here and watch it all day long because at the end of the day, they have 2 years to expiration. So I like to trade options with more of a long-term focus, but sometimes I do shorter-term trades, such as the VXX trade that I covered earlier, which you guys can watch and learn more about in the live stream once it's uploaded to the channel after we end here. Mark says, hello mate, just joined. I'm a complete beginner. Is this footage being recorded? Yes. So as I said, after we finish the live stream here in a little bit, then it will be uploaded to the channel. And with that, I think I'm going to end it here. I gotta go. We've been hanging out for a couple hours now. We covered a lot of good content. Earlier in the live stream, we did some live trading. So you can go ahead and rewatch all of that content. Once this video has successfully published to YouTube, it'll be on the channel. It'll probably be up in like 30 minutes to an hour because YouTube has to process the video before it'll be live on the channel. So thank you all for tuning in. Thank you all for the super chats. Futuristic Dad, thank you for the $5 super chat. I appreciate it. And yeah, we'll catch up soon. Stay tuned for future content on the channel. As I said, we're going to be broadening the scope a little bit from strictly options, and we're going to talk about everything that's in the investing umbrella, but we might talk about some economic stuff as well. But it'll all be finance related, so I'm really excited to start talking about some more stuff with you all. So thank you all for tuning in. As I said earlier, tastyworks is doing a special promotion right now through June 31st. If you open a new account, not a second account, but if you're a new customer, they're doing this promotion through June where you can get up to $200 in free crypto for opening an account. And if you fund it with $2,000, I think you'll get $200 in free crypto. So that link is in the description if you are interested in taking advantage of that. Otherwise, I will see you all very soon. Thanks everyone for tuning in, and I'll see you in a video shortly.